Hi, I'm Roger Montgomery and welcome to this week's Video Insight. E-commerce is an exciting global megatrend. In the 7 years between 2014 and 2020, worldwide retail e-commerce sales have grown from $1.3 trillion to $6.5 trillion. Now, Amazon, of course, is the undisputed leader with 37.3% US market share. And while much of the focus is on the Amazons, eBays and Alibabas of the world, there are a number of small Australian companies generating serious returns for investors from e-commerce. Australia's small companies offer a number of opportunities to gain exposure to the e-commerce theme, from online pure plays to omni-channel operators. Importantly, as this chart demonstrates, with 11% penetration of retail sales excluding the grocery category, online has a long runway for rapid growth in market share. The average developed market has nearly double the online penetration Australia has. The structural migration of retail towards online was already in train before the pandemic hit, and mobility restrictions have since seen it absolutely explode. According to Australia Post, online shopping grew 80% year on year in the 2 months to the 15th of May this year, and a new raft of customers who hadn't previously purchased online are now quite comfortable spending from their lounge, bed or home office. What's particularly telling is that although physical stores have reopened around the world, e-commerce sales have remained elevated, suggesting convenience, improved logistics and familiarity has resulted in adoption sticking. Experience tells us that many traditional Australian retailers were doing their best to avoid online investment prior to the pandemic. Now, this is partly our fault, and I mean professional investors' fault. Professional stock market investors don't generally like CapEx and the associated period of lower asset turnover. Today, however, retailers eschew e-commerce at their peril. Consequently, many are now scrambling to catch up, and so are stock market analysts. Of course, the beauty of online is that once built, the model is incrementally capital light as well as scalable, and we expect growth to be very strong for years to come. Currently, our first prize is any company with a business model that should emerge from the pandemic in a stronger competitive position, either by taking market share, resizing their cost base and/or strengthening their balance sheet, or some combination of those three. City Chic is an exciting global e-tailer with a structural component to its growth runway, and we actually believe it screens really well for all of the characteristics we're looking for: quality, growth and value. We believe management, led by CEO Phil Ryan, are talented, with a clear vision for the business and a strong track record of delivering ahead of expectations. Their strong brand and laser focus on plus-sized women's clothes is a genuine advantage against incumbents. While they are a small player currently, participating in a very large and underserved global market, that market is estimated to be worth north of $50 billion. Through disruption, they're taking share from traditional retailers, and unlike a traditional store rollout model, online growth is capital light and scalable, therefore generating stronger returns. City Chic also has over $100 million of cash on its balance sheet, which provides optionality for both organic growth and the acquisition of brands and databases. We currently expect City Chic to very soon introduce its offering in another large and underserved market, Europe. From its lows in March, the share price has already risen as much as 355%. And while it may look expensive, we currently believe 11 times EBITDA is cheap for a company that can grow at 30% annually. Now, of course, all this information is general in nature and it pertains to our own portfolio position. We're not recommending you buy the stock, and if you do transact in any securities, be sure to seek and take personal professional advice. And in the meantime, be sure to follow us on Facebook and Twitter.